Hey, Bulls and Bears, how are we doing? I hope you are doing well. Back with another dose for you. My name is JJ, and you're watching Bull Boom, Bear Bust. And we're back with another dose here of economic reality. As always, the economic tsunami, it's happening now. It's happening right now. You wouldn't know it by watching CNBC, the business news networks. You wouldn't know it, right? They're focused on the stock market. But as I warned here, and for those of you that have been on the channel, you know I've been warning about this, the disconnect between the Main Street economy and Wall Street, or what some people call the Wall Street economy, is getting wider and wider, further and further disconnected all the time. Just look at the S&P 500 here. I've got a recent chart up over here. We're up over, just in the past year, almost 32% on the S&P 500. Other indices, very similar. Folks, this is the disconnect that we've been warning about for years. And consumers are buried under record amounts of debt. Of course, most of you know that by now. But what's the end result? Right? How's this going to play out? Well, I'm positioning right now for something very similar to what I positioned for in 2019. And for those of you that have been on the channel, you know that at that time, I went to mostly a cash position, kind of like Warren Buffett and some of these billionaires. Of course, I'm not a billionaire, but some of these billionaires moving to large cash positions. We see major CEOs and executives cashing out of a lot of their stock. Look at Bezos, Zuckerbucks, many of these individuals that we've talked about here in this channel are going to, they're accumulating cash, right? So I feel the same way now as I did in 2019. Now, of course, 2020 brought a brief economic collapse, which really should have been a wipeout, much worse than the financial crisis. Of course, what happened, they pumped so much money into the economy that it was a very brief contraction, right? So we saw the supply chain issues, the rock bottom rates. Once again, they cut rates to basically zero, free money, all the handouts, corporate welfare, the bank welfare. It all was pumped out into the economy at unprecedented levels. So now we're still living with the effects of that. We're still living with the inflationary measures that took place after that, and the high cost of living, and consumers are getting really buried right now. Everywhere you look, consumers getting further and further and further behind on their payment obligations, delinquencies increasing, even foreclosures up, 10%, which is not a lot, but it's just the beginning. And with all the trillions of dollars pumped into the economy, all the rescue programs, we're still seeing the economy, or we're still seeing the Main Street economy, not Wall Street, but the Main Street economy get further and further buried, under this debt. So I think it will be just fine. This is not a message of fear. It's not a message of negativity. This is a message of positivity, because I think just us being aware of that, you and all my audience here, 99% of you, there's still the 1% where I get 99% thumbs up, about 1% thumbs down on average on my videos. So 99% of you agree, I think, and you see this coming, right? We're going to be prepared, and if you're ready for it, this is going to be a great opportunity, right? This is not a message of fear. This is a message of we're ready for this. We know this is coming, and it's not. It's coming. It's coming. It's coming. It's here now. It's just, if you can't see it, you're just not looking at the evidence, right? Again, look at the disconnect between Wall Street and Main Street. Look what the average consumer is right now compared to the stock market. It's just the opposite, right? Consumers, again, buried under record amounts of debt, delinquencies climbing. S&P 500 closed 5,234. And, this is just the beginning. But we got a lot of news to get caught up on today that's further going to underpin the message here that we've been talking about. We've got malls, entire malls closing down. We're going to talk about that here in just a little bit here. But let's get into this first. And wanted to start right here. More layoffs here. And this has to do with AI, artificial intelligence. Now, I think AI, this whole AI boom and all this hope about AI, I think it's the equivalent of the dot-com bubble, maybe even worse. Remember the dot-com bubble, everyone that had a website was thinking, okay, every company that has a website, they're going to multi-million-dollar valuations. Of course, that didn't happen. There was a few survivors, and some of them are still around even to this day. Look at Amazon and others. Most of them didn't survive, though. And AI, although it's completely different type of thing versus the dot-com boom, I think it's the mania and the optimism is similar, where any company that has AI, they're integrating more AI. They think they're going to eliminate most of their workforce and save all this money by not paying people, by having um, digitally, artificially um, created either content or service, right? Do you really think that AI is going to replace a human when it comes to service? Do you want to speak to an AI algorithm or a robotic voice when you call someplace? When you go to a food facility or any business, do you want to be greeted by an AI board or screen, or do you want a human, right? So some people say AI because they're going to say that's going to be cheaper, right? They say that the companies eliminating all this staff and all this workforce because of AI is going to save the companies so much money that the companies are then going to pass along the savings to you, the consumer, and everything's going to get cheaper, right? Do you really think that's going to happen? You really think that's going to happen? Think about this. Companies saving money, just think corporate tax cuts. Did they pass along the savings to you, the consumer? To big capital N and to big capital O? No. These companies, if they save money with AI, it's going right back into their own pockets. It's going right back to buying back their own stock. It's not going to the employee, right? They're going to pay their employees as little as possible. The ones that don't get eliminated by AI, they're going to pay their employees as little as possible, right? They pay employees just enough to keep them from quitting. In some cases, they still quit. We see a lot of people still quitting, switching jobs, looking for more pay, but they pay you just enough to try to keep you in the building or in the door, so to speak. And even that doesn't work a lot of times, but companies don't want to pay you enough to where you're going to be financially free. Because if they did that, one, you wouldn't need them. You would see more people quitting. They would just save up money after a couple of years and say, wow, look at all this money I have saved. I don't need to work. Of course, the companies don't want that. They want to keep you on the leash, right? They want to keep you on the labor leash. Um, the term that I've never heard before, but let's bring it to life right now. The labor leash, right? So many people on the labor leash. So AI, back to that, I digress. I'm sorry. AI is a .com boom 2.0, maybe even bigger, maybe even worse, right? All this optimism. Remember, anytime there's a market mania, when the stock market evaluations go way above typical averages or long-term norms, it's usually some sort of mania that they'll point to try to justify it. And one of the latest ones has been AI, right? So I'd say be careful out there if you're still heavily invested in the markets. I'm still in the stock market, but a very small percentage of what I've been invested in over the past few years. For those of you that have been on the channel, you know that I've been pretty bullish on the stock market. I always said they can pump so much money into the markets at the click of a button, and it's true, and it continues to be true. Look at the amounts of debt. Look at the national debt now, how it's expanding at record levels, right? It's no coincidence that the markets are still going up, but yet the consumers are going broke because consumers, the driver of the economy for the most part, are borrowing money just to keep their heads above water. And what happens when people borrow more money? Well, the banks do better, right? They're giving out more loans. The interest rates are higher. People are paying back larger and larger payments. People are starting to push back though on these higher payments. We're going to talk about that again here in a few minutes. But AI, what do you think about that? Do you agree with me? Is AI this mania that's unjustified? I think it is. Please let me know down in the comments here. But a few other things I want to get into: the housing market, the real estate market. Another big driver of the economy, of course. Anytime you can borrow hundreds of thousands of dollars to buy an asset, in this case a home, that's going to be positive for the economy, right? Borrowed money, aka spent money, is a positive force. It goes into the gross domestic product, the GDP numbers. It gives a bump to that figure, so the talking heads can say, well, look at the GDP, look at all the money that people spent, when really most of the money spent now is borrowed money, right? And one of the things with these commissions, so the 6% commission, for the most part, it's over now. You can still negotiate as a home seller. You can still negotiate your commission with the real estate professional, aka realtor. And it's always been that way. You've always been able to negotiate it, but it was really not done. I mean, 99% of the time, people would just pay the 6% commission, 3% to the buyer's agent, 3% to the seller's agent, and the home sellers, knowing that they had this big commission that they have to pay. Do you think they were maybe raising their home asking price because of that? I think they were. um, if you don't, I mean, you're probably in the small fraction of people that don't really see the big picture here, right? The more expenses that you have to pay as a homeowner, the more you need to get out of the home to make a profit that's going to justify selling the home. Now, in some cases, you have to sell the home because in some cases, homeowners are so financially strapped and buried in debt, they have to sell the home because of an emergency financial situation. But a lot of times, they're going to take their profits, maybe sell and go move to someplace cheaper. I know a lot of people, even on a personal level, I know a lot of people that did that here in California. They chose to sell their home because they could sell their home, take all this equity, hundreds of thousands of dollars worth of equity, and in some cases, buy a home for cash in some lower cost states. I personally know people that moved to Texas, that moved to Tennessee. Uh, Multiple friends and family moved to Oregon, right? I'm talking about coworkers, just people that I'm acquaintance with. My sister moved to Oregon, right? Just out of Eugene, Oregon, small town called Bonita. Home prices back then, she moved, 8 years ago. Home prices back then, ultra cheap. And, so that's a big thing. But back to home prices here and these commissions, people, I don't think, see the picture on this. Lower commissions is going to be a deflationary force in the housing market, right? So home prices have corrected somewhat. They've moved up here in the last couple months, but we're down year over year pretty significantly in the housing market. And I think this is going to be another deflationary force with realtors making less on these commissions. That's going to mean home sellers don't have to be so greedy because they can still make a profit. It's going to be easier for them to make a profit, not having to pay these 6% commissions, right? And it's always been negotiable, but now it's going to be more mainstream that the knowledge, hey, you don't have to pay these realtors 3%, 3%, 6%. And we'll see what this ends up doing. But the real pain is going to be felt in the real estate community, in the real estate market with realtors. And I think a lot of the part-time realtors are going to be leaving that industry completely, because if you're only doing it part-time and then you get these smaller commissions, after all the fees you have to pay and everything like that to be a realtor, it's almost going to be a break-even type of thing, right, for a lot of the realtors. Now, we already are seeing a mass exodus of realtors just because the slowdown and the low sales volume, right? So that's having a big impact by itself. Now you've got this on top of that. It's going to be could be a bloodbath. Some people have been using the word bloodbath here about the economy. It's been in the news. It's going to be a bloodbath in the real estate industry, but this could be a positive thing for sellers and buyers of homes, right? So please let me know what you think about that. Let's move on to the next topic here. Real briefly here, we've got more global conflicts unfolding. Here's just a recent headline. I'm not going to get too much into this. It's out of the U.S. Naval Institute. China attacks Philippine ship, injures crew, and latest escalation of South China Sea standoff. Right, we're seeing more and more nation versus nation hostility, and we're going to see this on a much larger scale. Not 10 years, not 5 years down the road, in the very near future. I think even this year, you're going to see some things that are going to blow your mind. The BRICS nations causing some hostility by trading outside of the dollar, basically going against the agreement that everything had to be traded in U.S. dollars from many, many decades ago. And now it's happening, right? De-dollarization is happening, and this is going to be another thing causing inflation, right? So it's pretty wild time. We've got this combination of deflationary and inflationary forces happening. Normally, the consumer being so far under debt would be deflationary because people would be drastically pulling back on spending as they reach the end of their credit rope, so to speak. But what's happening right now is banks are not limiting the amount of credit, aka debt, that consumers can take on. So we're seeing this debt explode into the stratosphere like many people never even imagined, right? People typically, when they think about debt or banks issuing loans, they think that there's got to be some limit that it reaches a point where the banks are going to stop giving out loans because the debt is too high amongst all their customer base, and the banks should be normally, in a normal world would be worried about the consumers, the borrowers' ability to pay back all these loans. We're at a time right now where the banks are not worried about that. The banks know that they're not going to be allowed to fail, right? So that creates a whole big mess. That's why you see valuations exploding, cost of living exploding, not coming down. And you've got the central bank, even with the cost of living still elevated, talking about rate cuts. How insane is this, right? Right. The housing market's never been more unaffordable. This is just one example. The housing market's never been more unaffordable. And we've got the central bank, even at this point where homes are at a record, uh, not a record high. I mean, prices have come down, but the unaffordability, when you look at the consumer, the state of the consumer right now, the mortgage rates, the unaffordability has never been higher. But yet we're still talking about rate cuts, right? It doesn't make any sense. If it doesn't make any sense, usually somebody's up to some shadiness, for lack of a better term, shenanigans. Bloomberg, home buyers expecting $10,000 savings with these lower commissions. I think it's going to be more than $10,000. I think this is going to have a bigger impact, not just on the sales figures going forward, but on the entire real estate industry. And I think that's going to be a bigger deflationary force. Now, anything could happen. They could bring in some rescue program where, just like 2020, where they put a freeze on foreclosures. I really hope that doesn't happen, because that would make the correction that's supposed to happen not happen. They could kick the can down the road even further, keeping this big housing bubble inflated and maybe even pumping it back up. Well, I really hope that doesn't happen. But we have to be realistic here to all the different possibilities, right? Anyone out there saying, oh, this is definitely going to happen, this is definitely going to happen. If you look back over the past few years, most of those people with that definite perspective saying, oh, this is definitely going to happen, and a lot of people that I followed fell into that trap, right? A lot of people right here in this platform, predicting a housing bust 2021, 2022. The housing bubble is going to crash. Home prices coming down 50, 60, 70%. Folks, a lot of these people don't realize where it all begins. It all begins at the source of the money, how the money is created. And when it's unlimited, then you have big problems, folks. Most of you know that, but I just want to kind of bring everyone back down to reality here. The Fed's bar says changes to capital rules likely to be significant. There we go, on the money creation. Banks right now don't have to have any money set aside to make loans. It's a big problem, folks. Think about how much lower the cost of living would be if banks weren't able to operate in this manner, right? If they had some restrictions, if they had some limitations on the amount of money that could be loaned out, you'd be seeing a whole different world right now. A lot of people that are working multiple jobs right now because of the cost of living might be able to retire. Like we talked about at the beginning, with companies not paying you enough to maybe work for 3, 4, 5 years and then retire because you made so much money. Companies don't want that, and it's almost not even possible with this cost of living, right? Um, Fed's bar says changes to capital rules will be significant. So how significant are we talking about? We're going to go from nothing to, it's going to be 5%, 10%, even 1% would be a huge change, from zero. You know what I'm saying? So something to keep an eye on, folks. It's another thing that's out there that's, uncertainty. And uncertainty is really enormous right now when you look at it. All right, folks, let's talk about a consequence or a symptom of the economic situation, with so many people being buried deeply into debt, and the desperation out there. An entire mall is closing. Let's go to this clip here. All right, let's go to our good friend's channel here, Cash Jordan, and listen to what he has to say about this mall closing. And something else we said was going to happen. We're going to see entire malls, more malls are going to close because of the economic situation that's happening right now.
We're talking about the Fulton Center in Lower Manhattan. There's a mall inside. The operator says crime has gotten so bad there, they are breaking the lease and closing down shops. But the MTA says, not so fast.
This here is one of the newest malls in New York City. It opened just 10 years ago, cost over $1 billion to build, but now it's closing because of crime.
Because of crime, folks. This is what happens when the cost of living gets out of control. And of course, there's lots of other things behind this, or reasons, but this is not good. I mean, when it comes to the Main Street economy, Wall Street, they can continue to pump this up until we see something that's going to freeze up the system of money right now. This could keep on going. It could get further and further disconnected. Ultimately, it's going to be a bankruptcy tsunami for a lot of consumers, and nothing to be ashamed of. A lot of people know that that's kind of the end result of running up all this debt. Most people know they'll never be able to pay off the debt, so bankruptcy is just kind of the accepted consequences of all this. And so it is kind of an escape card, right? Some people look at it as a negative thing, but I think it's a positive thing that we do have that um, in place. But the problem is a lot of people abuse it. They abuse it knowing they can just run up all this debt, take endless vacations, buy endless Starbucks because they know that the debt can be just discharged through bankruptcy ultimately. So there's bad and good. There's the people that abuse it, and then there's people that are just forced into it because of expenses they didn't intend to have to pay, like unforeseen medical bills, right? I'm afraid to see what my copay is going to be in my finger. For those of you watching this channel, I broke my finger, and I'm still waiting to get it looked at and x-rayed and stuff like that. I always try to avoid going to the doctor. I probably haven't been to the doctor in, I don't know, 3 years, 4 years. Um, Besides taking my kid there. Anyways, hope everybody's good. Let me know what you think about all this. The AI boom. Is it the dot-com bubble 2.0? Maybe even worse. What do you think about the mall closing? We know that's a financial result of a high cost of living. More layoffs. We talk about the actors going on strike because of not getting paid enough, the high cost of living. What else did we talk about? The big jump in S&P 500. Where does it end? What brings this down? You guys let me know what you think down in comments, and we'll talk to you very soon. And we'll see you on the next video. Keep stacking, everybody. Bye for now.